Thank you very much. Heard a lot of good things about this conference. And as always, I'm very pleased to have the chance to meet with you. I've come pretty much to all these conferences, certainly when I've been able to, and I found them to be very useful. As you know, this meeting brings together researchers, community development professionals, and public sector officials to explore how best to strengthen struggling communities. Needless to say, that endeavor is now more crucial than ever. The past few years have been very difficult. Weak economic conditions at the national level have translated into hardships in many communities at the same time that communities have fewer resources available for stabilization and revitalization. Considerable good work is going on nonetheless, and I'd like to offer a few examples of that today. At the national level, the economy is recovering at a moderate pace. In particular, the labor market has been gradually improving and the unemployment rate has declined somewhat. But unemployment remains quite high, particularly among minorities, the young, and those with less education. What's more, long-term unemployment is at historically high levels. Nearly half of the unemployed have been out of work for 6 months or more. The housing market is also holding back the recovery. The foreclosure rate remains very high, and many homeowners who have avoided foreclosures find themselves underwater, meaning that their mortgage debt exceeds the value of their home. Obviously, the problems in the labor market and the housing market are not unrelated. In particular, lost income from unemployment is causing many families to fall behind on their mortgage payments. As families have struggled, so have their communities. In some areas, for example, high foreclosure rates have produced significant numbers of vacant properties, depressing surrounding home prices, attracting crime, and creating financial burdens for local governments. Thus, some community development groups are just now trying to hold on to past progress that they've made in building up physical and human capital, while others have lost ground and are just really in the process of beginning the rebuilding. While the scale of the problems has been exceptional, many of the problems themselves are not new for lower-income families and communities that were already struggling. People who were vulnerable to begin with, those with low incomes, few assets, and less education, have had a more difficult time weathering the financial storm or recovering from setbacks. The same is true for communities that are relatively poor, with fewer community assets and insufficient drivers of economic growth. To solve problems, we must first understand them. Like many of you here today, the Federal Reserve has been engaged for some time in research and analysis of the economic challenges faced by neighborhoods and communities, as well as by individuals and families. For example, in 2008, the Federal Reserve Banks and the Board of Governors, in partnership with the Brookings Institution, published a study of the effects of concentrated poverty on communities. The communities that we studied included older inner cities in the north, smaller cities in the south and west, Native American reservations, gateway neighborhoods that are entry points for immigrants, and rural areas in the Appalachia and in the Mississippi Delta. What these diverse communities had in common was that they did not share in our economy's general prosperity, even in good times. Our research identified some of the barriers to economic progress shared by these communities, including inadequate schools and workforce skills, lack of investment in infrastructure and business development, and limited institutional capacity. Not surprisingly, these communities were particularly ill-equipped to deal with the recession. Of course, economic conditions in a given community both affect and are affected by the economic status of the individuals and families in that community. One of the most valuable sources of data on family finances is the Federal Reserve Board's triennial survey of consumer finances. To better understand the effects of the crisis on households, the Board, in a special update to its 2007 survey, asked the participants about their financial and personal circumstances 2 years later, in 2009. The findings help to illustrate the challenges that are still facing families and communities. According to this special follow-up survey, lower-income households continue to experience significantly more unemployment than higher-income households. In 2009, nearly one-fourth of the families in the bottom half of the income distribution had at least one member who was out of work for some portion of the year prior to the survey. This rate was about double what was seen in higher income households. Declines in the value of homes and stocks sharply reduced the wealth of many Americans during the crisis. 3/5 or more of families across all income groups reported a decline in wealth between 2007 and 2009, and the typical household lost nearly 1/5 of its wealth, regardless of income group. Moreover, 1 in 8 of the households in the panel started the crisis with zero or negative net worth, and thus had scant resources to fall back on or to maintain their standards of living during bouts of unemployment. Unemployment and declines in wealth obviously can make it difficult for a household to pay its debts on time. The survey update found that lower income households fell behind on their payments at a substantially higher rate than higher income households, perhaps not surprising. Among households with debt, about 11% of those with incomes in the bottom half of the income distribution fell 60 days or more behind on at least one of their obligations in 2009, compared with only about 3% of those in the highest tenth of the income distribution. Just as lower income households weather financial storms with more difficulty, the same is true of communities. Even before the crisis, some neighborhoods, towns, and cities were already in distress. Those areas already lacked sufficient assets such as strong public schools and community facilities, and rising unemployment and falling tax revenues reduced the funds available for public services even as the needs increased. Often, residents were disproportionately underbanked or unbanked and relied on expensive alternative financial service providers. In communities with already low housing values, due, for example, to oversupply caused by population shifts, the wave of foreclosures that began in 2007 sent the number of vacant properties soaring, causing a raft of additional problems. In short, the financial crisis and the recession touched many families